Welcome to this Kaplan webinar on types of risk. My name is Brad Charles, and I will be your instructor for this 1-hour course. I'm one of the brave instructors at Kaplan who teach both securities and insurance pre-licensing classes. I was in the industry for about 20 years, and I've been a Kaplan instructor for 10 years in May of this year, so technically, this is my 30th year in the business. Time sure flies when you're having a good time. This webinar is part of a series of 12 free webinars that Kaplan is offering over the month of April on topics that are common to all securities tests. For a list of classes and times, please contact Kaplan to get the latest updates. Due to the number of participants on this call, I will not be able to answer questions as we go through the material. So instead, my good friend, Giggs Taylor Stevenson, will be your moderator for this class. Giggs is our supervisor of instructors at Kaplan, so she will be able to help you with whatever you need. We do ask that you limit your questions to the material in this particular class. For questions regarding other topics, we recommend you attend a webinar on that subject. They are recorded, so if you miss one, they're all available to you on the Kaplan website. So let's begin, shall we? So this webinar is on types of risk. For those of you who are fans of the Star Wars movies, I call risk the dark side of the Force. You have to tell your clients about risk. They think you're going to be able to protect them from all risk with their investments, and there's no way that you can do that. So we have to tell them about the different types of risks involved in the investments that they have. For example, even a United States government bond, which most people think is, virtually risk-free, it does have inflation risk. Sometimes they call that purchasing power risk, which we'll talk about today. And it also has interest rate risk, which is the risk you have if interest rates move out there in the marketplace. It will affect the value of your bond inversely. And we'll talk about interest rate risk as well. So even a United States government bond that's fully backed by the full faith and credit of the United States government is going to have risk. So we have to talk about risk with every single investment that we recommend to our clients. After this webinar, you should be able to distinguish between the two categories of risk, which we'll talk about is systematic risk and unsystematic risk. Also the various types of systematic risk and unsystematic risk that's out there. And we'll also talk about duration when we go over the interest rate risk that you have with debt securities. So what are the two categories of risk? We have systematic risk and unsystematic risk. Systematic risk is risk that you cannot diversify away for your customers. It remains no matter what type of strategy you use with your customers. We cannot avoid systematic risk. And there's going to be a couple of different types of that we will go over together. We're going to start off with systematic risk, and then we'll move to risk. Unsystematic risk is actually inherent risk in the investment that you're actually working with, something that's unique to that particular investment. And we will see that we can diversify away unsystematic risk for people, and we'll show you how to do that with what's called portfolio management. So we'll work on that and show you what that looks like when we're working with someone who's trying to diversify away unsystematic risk that they have in their investments. So one of the types of systematic risk that we cannot simplify away for people is market risk. Market risk is the market going the wrong way on you. Going the wrong way on you. There's really nothing you can do about that. There are a few things you can use to mitigate the market going the wrong way, but honestly, the stock market does what it does. When we talk about market risk, we are normally talking about stocks and the stock market. I remember when 9/11 happened. I was working for a major financial services company here in the United States. At the time, they were the largest life insurance company in the world. They were the 4th largest securities company in the world and the 5th largest bank in the world at the same time. And when 9/11 happened, the market dropped almost 40%. And our particular stock had a beta, which measures your risk against the stock market, of almost exactly a 1. And 1 is actually the market itself. So when the market went down by 40%, our stock price went down by 40%. I remember the next day, the vice president of sales of our company and our controller got on a video conference call with every representative in our company and did an hour presentation on our balance sheet to show that there was nothing wrong with our company. We were still one of the strongest financial institutions in the world, but because the entire market went down, our stock price went down with it. I think they did that presentation because they thought we were going to quit when we saw the stock price drop, as much as it did because of 9/11. So that'd be a situation where you'd have market risk where you're long stock. When you're long stock, you're buying it and you own it. You normally, what you do is you buy stock for the purposes of the price going up in the future, and then you can sell it at a higher price in the future, so you want the price to go up. If the price goes down and you sell that stock, you're going to lose money. You're going to get hurt. So market risk is literally the market changing on you. Another name for that is volatility. Volatility. How much volatility do you have with your investment? And that volatility, what we do is we measure that with beta. Beta is a figure we use to measure how volatile your stock is compared to the stock market. They give the stock market a 1.0, and then they calculate a beta for your stock. It's a relatively simple calculation. You can just use a regular calculator for that. So you calculate your beta, or they give it to you, and you compare that to 1. If your beta is higher than 1 for your stock, that means your stock is more volatile than the marketplace. If your beta is lower than 1, well, then your stock would be less volatile for your beta. So beta is used to measure how volatile your stock is compared to the market. High beta stocks would be like 1.6, 1.7. Those are really high. They have a lot of market risk. That would be industries like the auto industry and the construction business, buildings, steel companies, steel industries are also very volatile industries out there. They have very high betas, so they're very highly affected when the market goes up. When the market goes up, they go up way higher than the market, but if the market goes down, they go down way faster than the market. So that'd be a high beta type stock that would have a lot of market risk. Low beta would be 0.3, 0.2, maybe 0.4. That's pretty low beta. That'd be a company that probably would be like a clothing company or a food company or maybe a pharmaceuticals company. Those industries really aren't affected that much by the stock market changing. They'll move, a little bit when the market moves, but not as much as the market itself. So those are called low beta stocks. So we have high beta stocks, we have low beta stocks. If you have a high beta stock and the market drops, you're going down faster than the rest of us. But the good news is if the market goes up, you're going to go up faster than the market. So that's what we use to measure the volatility of your stock in relationship to the stock market. So how do we handle market risk? Well, there isn't a whole lot we can do about that, quite frankly, because diversification does not work. So we're just going to put the old Ghostbuster sign over diversification. Diversifying people into many, many different types of stock does not help you if the entire market goes down. If the market goes down again, like it did recently here with the COVID-19 pandemic, there really is nothing you and I could have done about that. Everybody suffered. The good news is if people don't sell their stock right now, they're not going to get hurt. It's the people who are selling their investments right now when the market is really low. they're the ones that are really going to be hurt by that. So unfortunately, we do have a lot of clients out there that are selling off their investments at a time when it's the worst possible time to be selling, when the market is down like this. But like I said, diversification, spreading them out over many investments really isn't going to help with market risk. When all the boats go down, we're all going down with it. Interest rate risk is the risk you have with a debt security. A debt security would be a piece of debt of a corporation or a municipality or a government where you're lending your money to them and they're paying interest to you on that money. And then at the end of the maturity of that particular piece of debt, they pay money back to you. So it's literally a loan where they're lending money to you. So debt securities have interest rate risk. Works like this. Interest rates go up and down out there in the marketplace. They go up and they go down. There's different reasons why they do, but they do go up and down in the marketplace out there. Well, if interest rates do go down, the prices of debt securities goes up. So if you have a piece of debt that you own and interest rates go down, your bond price is going to go up in the marketplace. On the other hand, if interest rates go up in the marketplace, well, then your bond price would be going down. Your piece of debt security would go down in price. They are inverse of each other. Interest rates and debt prices are inverse of each other. Why are they inverse? Well, if you think about it, it makes sense. Let's say that you have a bond right now that's paying you 6% a year, and interest rates for your type of bond with your type of risk level drops to 4% in the marketplace. Your 6% bond looks really good out there in the marketplace. So what do people start doing if they think an investment is a good investment for them? They start buying it. So people start buying that bond that's the 6% bond in the marketplace. And if you know anything about economics, if the supply of something stays the same, the demand goes up for it, the price goes up. So the price would go up when interest rates went down because your 6% bond now is more valuable than a 4% bond out there in the marketplace. In fact, if you knew the duration of that particular bond, which we'll talk about in a minute, you could actually calculate exactly how far up or how far down that bond price would go in the marketplace. It takes a couple of days for it to adjust, but it will adjust after a couple of days to a certain level based on the duration of that particular debt security that you're looking at. So basically it works like this in regard to interest rate risk. The longer the maturity of your debt security, in other words, the longer it's going to be for you to get your money returned to you, paid back to you, the more volatile your interest rate risk will be here. The more volatile the price will be, which means you'll have more interest rate risk. And if you think about it, that makes sense, because if you have a maturity of a bond, let's say like a 30-year bond that you have, and bonds normally pay interest every 6 months, so you'd have 60 interest payments to worry about over the life of that bond, plus the principal payment on the back end, which is probably $1,000 on the test. So you have the $1,000 principal they're going to pay back to you, plus all the interest payments each year that you'll have on that. That's a lot of interest payments to worry about, and there's a lot of bad things that can happen between now and 30 years from now. So the longer that maturity, the more volatile your price is going to be, because there is more interest rate risk there. And we use duration to measure that, to measure how much interest rate risk you have, and I'll show you that in a minute. On the other hand, if you have a debt security that has a lower coupon rate, that is a lower interest rate on it, it's also going to be more volatile in regard to your price. It's going to have more duration. The longer the duration you have, the more volatile your price will be. So lower coupon rate type securities are going to have more duration, longer duration. They're going to have more interest rate risk. And also securities that have long-term maturities, they're also going to have more duration, longer duration, and they're going to have the increased interest rate risk. So let's talk about duration here, so you know how we use this figure to determine how much interest rate risk you have. Duration really is a time value of money calculation that you'd need a financial calculator or a computer software program on a computer device of some kind to be able to calculate it. And essentially what it is, it's the number of years it's going to take for you to get your original investment back using today's dollars. And what we do is we use a discount factor that is the current interest rate for whatever the type of risk you have with your investment. We use that discount rate to bring back all of the payments you're going to get from that investment and bring it back into today's dollars and come up with the number of years it's going to take to get your original investment back. Let's say that you have two bonds you're looking at. We have a 4% bond that's due on September 30th of 2025. That's when they're going to pay you the $1,000 principal back on that bond. And then we have another bond that's paying 6% a year, and it's also coming due on the 9/30/25 maturity date. So we've got the 4% bond and comparing it to a 6% bond. Which one would have the longer duration? Which one would have more interest rate sensitivity? Well, duration measures the volatility of the bond price by weighting that the time the bond interest rate takes to pay back your money for that bond. So the longer the duration, the higher the bond volatility will be. In this case, it's going to be the 4% bond, because the 4% bond is only paying you $40 a year on a $1,000 bond. You're only getting $40 a year. With the 6% bond, you're getting $60 a year. So you're getting more money each year, which means it's going to take less time for you to get your original investment back in today's dollars using the time value of money. The 4% bond is going to take more time, a longer duration, more years for you to be able to get your money back from your original investment, giving it the longer duration, and that's going to have a higher sensitivity to interest rate risk. On the other hand, if you had two bonds where they have the same coupon rate, in this case, we have two bonds that are both 4% for our coupon rate, but we have different maturities with these bonds. This bond on the left has the September 30th, 2025 maturity date. The one on the right has a September 30th, 2030 maturity date. So it has a longer maturity. If the coupon rates are the same, the bond with the longer maturity is going to have the longer duration. It's going to take longer for you to get your original investment back, and based on today's dollars, so it's going to have the longer duration. It's going to have the higher sensitivity to interest rates. So if we have two bonds with the same coupon rate, pick the bond that has a longer maturity, and that's the one that'll have the most duration for you. One type of question you might get on duration is they could give you 4 different answers, and they give you each one that have a different coupon rate and a different maturity date on it. In that type of question, you want to pick the one that has the lowest coupon rate and the longest maturity. That'll be the correct answer. That's the one that's going to have the longest duration and have the most interest rate sensitivity to it. The only other bond that you might see on the test that could cause you a problem on a duration question would be a zero coupon bond. A zero coupon bond doesn't pay any interest to you on an annual basis. The only way you get money back on a zero coupon bond is on the day of the maturity. You buy it at a really, really low discount, way underneath $1,000, and then you get your $1,000 back, if that's the maturity value, on the maturity date. But you don't get any money between now and then. So actually, the duration of a zero coupon bond is the maturity of that bond. So if they ask you, what is the most volatile bond out there in regard to duration, in regard to interest rate sensitivity, it'd be a zero coupon bond, all things being equal, because the maturity and the duration on a zero are going to be the same number of years. So if it's a 20-year zero coupon bond, your duration would be 20 years. 20 years before you get any money back from that thing, because you don't get money back on a zero until the actual maturity date. So if you see a zero coupon bond, I pick that. All things being equal, that's going to give you the longest duration and the most interest rate sensitivity. Call risk is the risk that your security could be called. Callable securities can be called by a corporation or called by a municipality. What does that mean? Well, it means that they have the right to buy it back from you. Let's say that you have a bond that's callable, a callable bond, and you have a callable bond of a corporation. Interest rates fall in the marketplace. What does everybody do when interest rates go down? They refi. They refi their debt. I remember when interest rates went down dramatically here several years ago. My wife and I refied our house in 2011, and we saved $287 a month on our mortgage. And I had plans for that money, but then one of my daughters decided that she wanted to get married in Jamaica, which cost me a fortune. So we wound up using the $287 a month to pay for our trip to Jamaica and the wedding down there. But since 2017, we got my daughter married off, and we've been using that money for retirement savings since then. So that's a big deal. When you refi your debt, you can dramatically increase your income flow. Well, that's what corporations do. That's what cities and counties and other municipalities do when interest rates fall. They refi their debt by calling all the debt securities they have out there. We also have callable preferred stock. That's stock that the corporation can call. Literally what they're doing is they're buying it back from you. They buy it back from you. It's what's called the call price. The call price is a good price that they're going to give you for that security. You have to take the money for the call price. They're literally buying it back from you because interest rates are falling in the marketplace. So they're literally paying you back early before the maturity date. And what they will do is they will go ahead and buy back. Let's say you have a 6% bond and interest rates have dropped to 4%. They'll go ahead and buy back the 6% from you, and they'll offer a 4% bond in the marketplace for investors so they can purchase that if they wish. So that's a callable bond or callable preferred stock. Basically, it has a call protection on it. Call protection is the number of years it's going to be before the call date. The call date's the earliest date they can call you. So maybe you have a bond that's a 5-year call protection on it or a 10-year call protection on it. But once you're past the call date and interest rates fall, you can bet your boots they're going to call your security. They're going to refi your security and buy you out. So when interest rates fall, expect a call from your company or municipality that you are working with, and they are going to call you on that particular callable security. Reinvestment risk is the risk you have when you receive money either on a callable product or at maturity of a product, maturity date, when interest rates have gone down. You have to reinvest your money at a higher risk level to get the same return you were getting before. So reinvestment risk is inherent with securities that have some sort of income flow, and the income flow out there has gone down. For example, interest rates have gone down. You're going to have to reinvest your money at greater risk to get that same return. So really the definition of reinvestment risk is the inability to use your funds from one investment and reinvest them, earning the same rate of return at the same level of risk that you were taking before. We were talking about callable products. They automatically have reinvestment risk when you receive the call price, when you receive the money from the company or the municipality. You're going to have to reinvest the money at greater risk to get the same rate of return because they're going to offer you a lower interest rate in the marketplace. And that's because interest rates have gone down generally across the marketplace. So they're going to offer you an interest rate that is lower. So maybe you had the 6% bond and now the company says, we'll offer you a 4% bond if you wish to do that with us. And you'll say, well, I don't need 4%, I need 6% of my money from this investment. That means you're going to have to take on more risk to get the same rate of return you were getting before. Another great example of that is someone who has a United States government bond that is coming due on the maturity date. Maybe they had a 30-year government bond. Well, 30 years ago, interest rates were way higher than they are today, way higher than they are today. So they're getting a nice interest rate on the government bond from 30 years ago, and they get that interest rate every single year for 30 years. Now the bond comes due, and they go ahead and pay the maturity value on that bond to the customer. Let's say it's $1,000. Now they got to reinvest that money at greater risk to get the same rate of return they were getting on their government bond when they started it 30 years ago. You know, when interest rates went down to historic lows here in the last 10 years or so, for a while there, people were having to reinvest a United States government bond that has virtually, well, no default risk, virtually no default risk in terms of defaulting on the bond. And they had to invest in a C- corporate bond in order to get the same interest rate and the same rate of return that they were getting on the government bond because interest rates had gone down so far. A C- bond is a very, very dangerous bond in regard to default risk. So there's a person who is going from a virtually, default risk-free product to a product that had tremendous default risk because of the fact that interest rates had gone down. I call that sticker shock. Reinvestment risk is sticker shock. Trying to reinvest your money and getting the same rate of return you were getting before when interest rates have fallen. Another type of risk out there that we face for our clients is inflation risk. Sometimes they call this purchasing power risk. This is the erosion of your purchasing power of your particular currency that you're using. The currency, of course, we use in the United States, we use the United States dollar. So what we use in the United States to measure inflation is the CPI, the Consumer Price Index. That's the inflation rate the government uses to measure how much inflation we have out there. What they do is they take a basket of goods and services across many, many different industries. It's a humongous calculation, and they weight it based on different industries and different types of products, and they come up with a figure of how fast prices are going up. They actually measure it every month, so you can look it up every month to see how much prices went up in the last 12 months. So they report that every month, so you can see, I take that back. They calculate every month, but they actually report it Yeah, they report. They don't actually report it. You look it up if you want to. It's very easy to look it up on the internet, and you'll be able to see what the inflation rate is doing each month. Now, you probably know inflation's really low right now. It's been super low for the last 10 years or so, but in the past, inflation's been a lot higher. In the late 70s, early 80s, we had record-setting inflation rates. In 1980, the inflation rate was 12.6%. That is the highest ever recorded since they've been keeping track back in 1965. Right now, inflation is around 2%. Very low inflation rates that we have today, but in the past, they've been a lot higher. And they very strongly impact fixed dollar investments. A fixed dollar investment would be like a piece of debt, a debt security that has a fixed interest rate on it that you're receiving every year, or preferred stock that has a fixed dividend rate on it every year that you're going to receive. If inflation goes up, your purchasing power risk is going to go up, and you're not going to have be able to do as well with that product. Inflation's higher. Your real rate of return on your investment is the rate of return on your investment this year minus the inflation rate. That's your real rate of return. So you have to subtract that out. Well, some investments have rates of return that are at or below the inflation rate. You take a look at bank CDs right now. I mean, bank CDs are paying what, about 1.5% maybe on a 1-year CD, 1.5%. Now you got to take the taxes out of that because people have to pay tax on their CD interest. So you take that out. Maybe they're only making 1.2% after you take the taxes out. If the inflation rate is 2.2%, that person is losing 1 cent a year on their investment, and they may not even know it because they're not aware of inflation risk. Inflation risk. Older clients are the ones that don't take an inflation risk into account as much as younger people do. Older folks, you know, they have a window of time between, you know, the time that they're going to be with us and the time that they're not going to be with us, and it's a shorter time than younger people. So they really don't take into account the effect of inflation over time. And what happens is they wind up investing in products that are too conservative, and they're not able to beat the inflation rate over time. So we need to help them with that. One of the ways we can help them is using TIPS. TIPS are Treasury Inflation Protection Securities. These are government securities. They're government securities. They're offered by broker dealers, but they're actually government securities. Very safe investments for people. But what it does is it actually takes your principal. Let's say your principal is $1,000. Again, that's the money they pay back on the back end of a debt security. Let's say it's $1,000. They actually increase that every 6 months when they pay interest to you. And they increase the principal by the inflation rate, actually 1/2 the inflation rate, because they use 6 months on that. So they increase it by 1/2 the inflation rate, and then they multiply that increased principal times 1/2 of your coupon rate, which increases your interest payment for that 6-month payment. So effectively what it does, it increases your interest payments by the inflation rate as you go. Technically, it increases your principal as you go, but it will effectively increase your interest payments as you go, keeping pace with inflation. It's the only product that does that. So if you see a question on the test that asks you, what is the only product that literally keeps pace with inflation? I would pick TIPS, Treasury Inflation Protection Securities. They are wonderful investments to talk about with older senior citizen type investors who really aren't taking inflation into account as much as they should. So that's systematic risk. Systematic risk are things we really can't do anything about. We can't do anything about interest rates changing out there in the marketplace. We can't do anything about the stock market changing in the marketplace. I mean, those markets do what they do. There's nothing really we can do about that. But unsystematic risk is something we can help our clients with. This is the risk that is inherent in the investment that you're actually investing in. What types of risk does it have specifically? So it's risk that a company would have, or an industry would have. If you're investing in an industry of stocks, or a sector like an industry sector, will it fail or perform poorly because of its characteristics that are unique to that particular investment? So this is the old adage, don't put all your eggs in one basket. My grandma used to say it all the time. I would say that's an axiom in our business. And an axiom is absolute truth. You don't invest in just one company. You invest in many companies across many industries. And then you also invest in many different asset categories. Besides stocks, you have other investments beside that, and spread yourself out so you don't have all your money locked up in one particular type of investment or one particular company. So we diversify people across many different types of investments. We diversify them into insurance products and different types of savings products that they have to make sure that they're not all wrapped up in one particular type investment. We call this diversification. Diversification is incredibly important when you're talking to customers out there. I remember a study that we had at my company several years ago that found out that 92% of successful investing is not timing the market, knowing when to buy, when to sell. It's staying diversified with your investments. So diversification, incredibly important for folks out there, and we can really help them do that. We have the ability to do that, to spread people out. So we put them in equities, that would be stock type investments. We put them in debt instruments, debt securities like bonds and notes and government type securities. We put them in cash maybe, or cash equivalents like maybe money market type instruments. We might talk to them about real estate, where they can invest some of their money in real estate type assets. The great thing about real estate is it has a very, very low correlation with the stock market. It's really not affected by the stock market very much. So if the stock market goes down dramatically, your real estate really shouldn't be affected by that very much. Same thing with commodities and futures. Now, that's going to be a more speculative type of investment, and maybe a small part of their money can be invested in something like that. That also has a very low correlation with the market. Commodities is where you're buying physical assets, like you're buying barrels of oil and bushels of wheat and ounces of gold. And then futures would be where you're betting on the prices of commodities. You're betting on the price of oil in the future. You're betting on the price of wheat in the future. So that's a speculative investment, but it does have a very low correlation with the stock market. So that might be something you talk about with folks, to give them some diversity in their portfolio investments, to spread them out so they don't get burned by one particular type of asset. You spread them out into many asset categories. And then within each of these pie pieces, you dramatically invest them inside each of those pie pieces. Like, for example, with the equities, you probably would have stocks that are large cap stocks, large companies, mid cap stocks where they're mid-sized companies, small cap stocks where they're small type of companies, and spread them out over many different types of companies and those type of sectors. With debt securities, you probably would have some corporate debt that they would own, and also some government debt they would own, and you can dramatically diversify them across those types of that type of asset category as well. You learn about that in your Series 65 or 66 class. We call that portfolio management. So you'll actually get quite a bit of education on that if you take one of our classes in the 66 or 65. One type of unsystematic risk is called capital risk. Another name for this is principal risk. Essentially what it is the risk that you could lose all your money. So if you invested all your money in one stock and that company went bankrupt, you lose all of your money. So we have to make sure people understand that if they do invest in just one stock, all the money is invested in that stock, and that company goes bankrupt, they liquidate, they go out of business, they can lose everything. They can lose everything. So that's capital risk or principal risk. Literally the risk you can lose all of your money. That probably would not be a factor if you're talking about a bond, because with a bond, the company probably has the ability to pay you back in a liquidation. At least they're supposed to be able to do that. But if you have a stock of a corporation that you own, we're going to see in a couple of minutes that in the liquidation priority of a company, they don't owe you a dime if you own a stock in a company. So I think on the test, when they talk about capital risk or principal risk, they are going to be referring to a stock that someone would own. Business risk is when businesses make mistakes. Do they make mistakes sometimes? Well, yes, they certainly do. And when they make a mistake or they have a problem of some kind at their company, it can definitely negatively affect their stock price. So maybe we have a company that's a manufacturer of some kind, and their employees decide to strike because of low wages, poor benefits, whatever, maybe poor working conditions, something like that. So the employee union of this company, the union decides to strike, and they don't have any workers to work the factory. They don't have to shut the factory down. Of course, the marketplace is going to find out about that because the media is going to report it. And then people are going to start selling that stock right and left. And we talked about economics earlier. If the supply of something stays the same, the demand goes down, the price goes down. So people start selling that stock. That's going to drive that price down. And people will sell stock if they think the company has some sort of labor issue with their workers. Another type of business risk you might see is a lawsuit against a company. You know, maybe they have a lawsuit against them and they're in the process of that lawsuit. The media will again pick that up. They'll report that. People find out about it. If they think that that lawsuit is going to impact the company financially, where they're going to have to cough up money out of their profits in order to pay for that lawsuit, maybe they don't have a particular type of insurance to cover this kind of a lawsuit. Maybe they don't. And if that's the case, that money's going to have to come out of their bottom line, their profits for the year. People are going to start selling that stock right and left if they find out that that lawsuit is going to impact the bottom line, the earnings of a corporation. And also, sometimes companies just make bad decisions in terms of management. Let's say we have this company here that manufactures widgets. When I went to college, in the business school, every case study I can remember was a company that manufactured widgets. Now, we don't know what widgets are, but they're like these imaginary products that this company would manufacture. Maybe they use inferior materials to manufacture their widgets. And when people start using the widgets are falling apart all over the place because of the inferior materials we use to manufacture our widgets. Well, guess what's going to happen? Again, the media is going to pick that up, and people are going to find out that these widgets are blowing up all over the place, and people are going to start selling that stock, and that stock price is going to suffer dramatically because of that. So that's another possible business risk that we could have. Liquidation is a business going out of business. Out of business. That would be Chapter 11 bankruptcy, I believe, is where you go into bankruptcy and you're not coming out. So this is a company that's literally just going to sell all the stuff they have, all the stuff they own, pay off all the creditors, and literally go out of business. Now, there's an order that they go through this in the bankruptcy. They have to pay the wages off first, wages that they owe their workers. Then they have to pay their taxes to, the U.S. government and local government, state government, city governments. They got to pay their taxes second. Then they pay off secured debt. Those are debt holders of the corporation, where they have loaned money to these people and they have assets to back it up. They have collateral to back up that debt. They'll sell the collateral the company owns and they'll use that to pay off those bondholders. So secured bondholders are paid off first in terms of debt. They're the first people that pay off in a bankruptcy, in liquidation. Then they pay off their unsecured debt. Unsecured debt are sometimes called debentures. Debentures, that's a synonym on the test for unsecured debt. So they pay them off after the secured debt, and they also pay off their general creditors at the same time. General creditors would be like accounts payable, where they bought stuff on credit and they owe money on their credit lines for those items that they purchased. So they actually pay off their debentures and their general creditors at the same time in the bankruptcy. So they pay them off together. Then they pay off the subordinated debt if they have that. Subordinated debt is debt of the corporation they subordinated underneath their debentures and their general creditors in the liquidation priority. They would pay them off after they pay off their debentures and their general creditors. So they call that subordinated debt, or sometimes they call it subordinated debentures. That's the last piece of debt a corporation pays off in a bankruptcy. Then they pay off the preferred stockholders if they have them. Not all corporations offer preferred stock, but if they do, they pay the preferred stockholders off next, and the common stockholders are paid off last in a bankruptcy. So common stock is the most junior security in liquidation. It's the last people to get paid in a bankruptcy. Preferred stock is called a senior security to common stock because it's one level up in the liquidation order. So common stock is the most junior security, and preferred stock is a senior security to common stock. Now, the way you can remember this is a little way that I teach my students how to remember the liquidation priority. It's when the stocks drop is for debentures, gentlemen serve pina coladas. Gentlemen serve pina coladas. So when the stocks drop, gentlemen serve pina coladas. That'll help you remember the liquidation priority for a FINRA test, for a securities test. Then we have default risk. Sometimes they call it credit risk. This is the risk the company is not going to pay an interest payment, or maybe they can't pay the principal payment on the back end, which would be even worse on the last day of the bond. Now, we can mitigate this by taking a look at the ratings of that bond. A bond rating is a figure we use to take a look and see how much risk we have in regard to default risk. It only applies to debt securities. We don't look at default risk for a stock. We only look at default risk for a piece of debt security. That'd be like a bond or note, some type of piece of debt of a corporation. It's also referred to as financial risk. Financial risk of the company. What type of risk do we have in regard to them not paying me an interest payment in the future, or not paying me the $1,000 or whatever my principal payment is on the back end? Now, the rating services to take a look at that. A's are excellent. B's are usually okay, not always, depends on what kind of a B it is. And then we have C ratings, we have D ratings. There is no F. If the company gets an F, they flunk, and that's a company that essentially is in bankruptcy. So you're looking for the higher ratings if you want someone to have safety. So we're looking at this little chart here. You can see that for Moody's is one of the rating services out there. Their highest rating is AAA, and then Standard & Poor's, another big rating service out there. They're also AAA. Standard & Poor's uses capital letters, where Moody's uses capital letters and small case letters. That's how you can tell the difference. And Standard & Poor's, you might also see a rating service called the Fitch rating service. And the Fitch Rating Services also use a capital letter similar to Standard & Poor's. So if you see the Fitch Rating Service, well, that looks like Standard & Poor's. Now, when you're looking at Moody's and Standard & Poor's, the Baa rating for Moody's and the BBB rating for Standard & Poor's is where the investment grade bonds, investment grade securities begin. Investment grade is the safe stuff. It's the low risk default, low risk of default, and they're going to have a lower interest rate on them because they're safer. Less risk means less reward, and if your interest rate is lower, that means your yield is lower. Yield's your rate of return. So this is the low risk, low yield bonds. Those are the ones that are going to be Baa for Moody's and BBB for Standard & Poor's and Fitch and up. Everything above that is going to be your investment grade. Everything below that line is going to be your speculative grade, or sometimes they call them high yield bonds. Those are going to have higher interest rates on them because they have much more default risk. Much higher default risk on that, and because you're taking on more risk, they got to offer you a higher interest rate to compensate you for that. So it's going to have a higher interest rate and a higher yield. Sometimes they call them high yield bonds or speculative bonds. If you keep going on down the chart, you get into some very, very scary default risk type bonds down there. Years ago, we called them junk bonds. I'm not supposed to call them that anymore, but those are the very, very scary bonds in regard to high default risk. The way you can remember this one is Ba black sheep. Have you any wool? Ba is Baa. That's Moody's. That's where the investment grade begins for that. And then if you write Ba black sheep vertically on a piece of paper, you'll see 3 B's stacked up in each other. That's Standard & Poor's, and Fitch. So Baa and BBB, Ba black sheep, is where the investment grade begins on the rating services charts. Another type of unsystematic risk we have is legislative risk. Legislative risk is the risk that the government could change laws out there in the marketplace. It could be a state law or a federal law, and it's going to impact a particular company either adversely or it could influence them positively. It depends on what it is. I think on the test, they normally ask you about tax laws in regard to that. So recently we had the Tax Reform Act of 2018 that went into effect last year in 2019, where they lowered tax rates down dramatically for corporations. The top bracket for corporate tax was 35%. We had one of the highest tax top brackets in the world here in the United States, and they lowered it down dramatically down for corporations. And essentially what that did for corporations, it allowed them to pay less in taxes, which means they would have more money after tax to either grow the company, spend more money to grow the company, or they can use it to pay out dividends to their stockholders. So essentially what it did is it increased the earnings of the corporation by the tax laws, tax law being lowered, by the tax rates being lowered. So that positively affected stocks. The stock market, the economy really responded well to that. Stock market, as you know, went crazy here in the last couple of years, right before we had the terrible COVID downturn. But yeah, stocks have been going crazy, and one of the reasons they've been going up dramatically is because they did lower the tax rates out there for our corporations, giving our corporations more income to work with in regard to growing the company or paying out dividends to their stockholders. Regulatory risk is where governments change regulations. That can also positively or negatively affect a corporation. The EPA, the Environmental Protection Agency, very, very powerful agency out there. It is an agency of the executive branch, not the legislative branch of our government. So it's actually it would be under the category of a governor of a state or in the category of the federal government. In this case, it'd be the federal government. At the state level, we have the Department of Natural Resources. They're also a very powerful organization here in Wisconsin, where I'm from. So you have to deal with them in regard to regulations. If they, really create very, very strong, strict regulations, that's going to adversely affect companies, because they're going to have to spend more money in order to comply with those regulations, more time, more effort, more money, and that's going to have their stock price suffer because of it. On the other hand, if they reduce regulations, that's a positive effect for most companies, and they wind up having more money to be able to grow their company and pay out the dividends, and that'll drive up the stock price of the company too. So the EPA, very, very powerful. So is the FDA, Food and Drug Administration. My goodness, if you're a drug company, you cannot have a new drug hit the marketplace unless you get past the FDA. So you're at their mercy. Even if you have the best drug ever in the history of the world, if you can't get it past the FDA, you're not going to be able to sell it in the marketplace. So they're very powerful too. And then we have the EOC, Equal Opportunity Commission, that makes sure that our hiring practices are fair, and we're making sure we're not discriminating against anyone in any way. I was a hiring manager for my company for 5 years, and I worked very closely with the EOC, making sure that our company was following all the standards in regard to that. We actually launched a program from scratch that I was a part of to make sure that our hiring practices across our company were always going to be complying with the EOC regulations. That's another very powerful regulatory body out there that can cause a lot of misery for companies if they disobey the compliance regulations that we have for equal opportunity. Then we have political risk. Political risk really is when you have an investment that is, in another country, overseas, and it's affected by some sort of change in government administration of that particular country over there. Let's say that you're investing in a stock of a company in a foreign country, and the government of that country decides to nationalize the industry that your company is in over there. Sometimes they'll nationalize like energy type industries, like oil industries and natural gas, or maybe they nationalize the financial industry of a company. That is going to dramatically affect your stock price, because now your company cannot actually make decisions that benefit the company. They're literally being run by the government. So the government makes all the decisions by nationalizing it. You probably know that that's what happened down in Venezuela. They nationalized their industries down there, and Venezuela is in big, big trouble financially. It's very, very sad for the people of Venezuela down there. And the stock prices have just cratered down in that country because of the nationalization of those industries down there. So political risk really is a risk you have when you're investing in a company or an asset in another country. You're at the mercy of what happens in that particular country. Then we have liquidity risk. Liquidity risk is the risk that you cannot turn your investment into a cash situation, the ease or speed of converting it into cash. Now, some investments are very liquid. If you own a stock or a bond in the marketplace, that should be something you should be pretty easily have very, very high liquidity. Certainly if it's on the New York Stock Exchange, let's say a stock is on the stock exchange, you can just call your broker dealer. They'll go ahead and sell that stock right on the floor of the exchange for you, and you'll be able to get your money for it. So some things are very liquid. Probably the most liquid investment out there would be like a money market mutual fund, because a money market mutual fund, you can just write checks out of it for any dollar amount you want. Super liquid. So some of our investments are very liquid. Other investments, not so much. Probably the most illiquid investment on earth is probably a limited partnership. If you're a partner in a limited partnership, the only way you can get out is to get the permission of the general partner, who makes all the decisions for the partnership. If you can't get the permission to sell your interest, you can't get out. And even if you do get permission from a general partner, where do you sell your limited partnership? There's no active marketplace for that security. So it's almost impossible to sell, even if you were able to sell your interest in a limited partnership. So some things are very illiquid, and other investments would be very liquid. So liquidity is a factor with folks when you're talking about investments. By the way, liquidity is not the same thing as investment risk. Investment risk is, you could lose your money. Liquidity risk is not the same thing. Liquidity risk is, well, I can't turn it into cash easily, but could I still lose a lot of money on my investment if I sell it? Yeah. So liquidity risk is not the same thing as investment risk. Investment risk is a risk that, my investment could go down and I could lose money if I sell it. Liquidity risk is, can I turn it into cash easily? So they will try to confuse you on the difference between investment risk and liquidity risk. So be careful of that on a securities. Then we have sovereign risk. Sovereign risk is when you're investing in a debt security of another country, like a bond from France. You're investing in a bond of the French government. So what you're doing, you're lending money to France for your bond, and they are paying you interest every 6 months, or annually, depending on what type of bond it is. And it's like a corporate bond or a U.S. government bond. It's paid out similar to that. If you have a bond of France, you're probably okay, because France is a very strong country, been around for thousands of years. They are a highly developed infrastructure. You're probably going to be okay with that. I don't think you'd have to worry about them defaulting on if it's a French bond. So if it's a developed country that's been around a long time, they have a very strong financial infrastructure, you're probably going to be fine. It would have pretty low sovereign risk. But maybe you're investing in a bond of a smaller company, a smaller country. Maybe it's the country of Belize. We've got the country of Belize here, and maybe you're investing in one of their bonds. Well, that's a much smaller country, hasn't been around as long. They don't have the same financial infrastructure that France would have. So you would definitely have more sovereign risk with that type of investment. The final type of risk we're going to talk about is currency risk, and that's the risk that a currency of another country can change against the US dollar. US dollar is the benchmark for all the major currencies around the world. So if you're investing overseas, what you're doing is changes of money in their currency, not the United States currency. Well, if the foreign currency goes down and you take that foreign currency, if you sell something, you get the foreign currency, and then you turn it into US dollars, you'll lose money on the foreign currency exchange when you're exchanging the foreign currency for the US dollar. So it basically works like this. If the US dollar gets stronger against foreign currencies, you're going to have more foreign currency risk with those investments, because you're going to get fewer dollars for the foreign currency that you're exchanging. you're exchanging. You have that risk with American depository receipts. You also have that risk really with any type of investment that is overseas. So that ends our webinar on types of risk. Thank you for participating in this. Please stay safe. Thank you for using Kaplan, and we wish you the best of luck in your preparation for your test.